On May 4, 2025, a significant shift occurred in the long-standing trade war between the United States and China. A new chapter opened as Beijing expressed a conditional willingness to return to the negotiating table. This came after months of escalating tariffs, tightened regulations, and rising geopolitical tensions that not only strained the relationship between the two superpowers but also rippled through global markets, affecting millions of businesses and consumers. For years, the trade war has been marked by tit-for-tat tariffs, rhetorical clashes, and strategic maneuvering. However, this latest development, the possibility of renewed talks, has raised key questions. Is China genuinely extending an olive branch, or is it setting a trap? Is Washington ready to back down, or is it attempting to reset the narrative in an election year? And most importantly, what does this mean for the rest of the world? In this 30-minute special, we'll explore the economic, political, and diplomatic stakes behind this sudden opening for dialogue. We'll break down the context leading up to this moment, analyze each side's strategic motives, examine the implications for global supply chains and financial markets, and forecast what might happen next. Through expert commentary, data analysis, and geopolitical storytelling, we aim to deliver not just a summary of events, but a deeper understanding of the forces shaping our global future. Whether you're a business owner watching price fluctuations, a policymaker assessing risks, or a curious citizen trying to make sense of world affairs, this is the episode that will bring clarity to chaos. To understand how we arrived at this moment, we need to rewind the tape. The US-China trade conflict didn't start yesterday. It has been a slow-burning economic confrontation that dates back more than a decade, fueled by mutual distrust, growing competition in technology and military sectors, and clashing political ideologies. In early 2025, tensions hit new highs. The Trump administration, newly re-elected and emboldened by a nationalist economic platform, enacted sweeping new tariffs, most notably a 145% duty on all Chinese imports valued under $800. This ended the long-standing de minimis exemption, which previously allowed e-commerce giants like Shein, Temu, and AliExpress to ship goods cheaply and quickly to American consumers. The administration justified the move as a matter of national security and economic fairness, citing concerns over counterfeit goods, data privacy, and illegal fentanyl shipments disguised in small parcels. But critics argued it was a political stunt aimed at rallying protectionist sentiment ahead of the 2026 midterms. China responded with its own measures, a 125% retaliatory tariff on over 200 categories of American goods, including agricultural products, industrial components, and automobiles. More significantly, Beijing announced new export restrictions on rare earth elements, vital for everything from smartphones to electric vehicles and defense equipment. This signaled a willingness to weaponize its dominance in key resources, a card China had held back in previous rounds. When China broke its silence on May 4, 2025, its tone was notable, not defiant, not submissive, but measured. The Ministry of Commerce in Beijing released a formal statement saying that the Chinese government was evaluating the conditions for a renewed dialogue. That phrasing may seem vague, but it was packed with diplomatic weight. China was neither begging for negotiations nor rejecting them outright. It was sending a signal: we're open, but only if you show respect. This approach wasn't accidental. China is acutely aware of its global image. In previous rounds of conflict, Beijing was criticized for aggressive countermeasures, often seen as escalating tensions. But this time, it played a different hand. Instead of threatening retaliation or walking away, it invited the US to make the first serious move, on China's terms. The statement also included subtle preconditions. First, any talks must involve the rollback of current tariffs. Second, both sides must treat each other as equals. Third, China expects discussions to stay within the framework of the World Trade Organization and international norms, an implicit pushback against unilateral US actions. Behind the scenes, analysts suggest Beijing is also leveraging this moment to reassert leadership within the global South. By appearing restrained, principled, and ready to cooperate, China gains credibility with emerging economies that are also weary of US economic pressure. In diplomatic circles, this move is referred to as soft power maneuvering. China knows that real influence isn't just about tariffs or embargoes, it's about perception. If the world sees China as a rational actor and the US as a bully, the battle for moral high ground shifts. This calculated diplomacy is further reflected in media messaging. Chinese state TV focused heavily on images of stability, factories running, farmers planting, young people studying abroad. It's a contrast to the political noise in Washington, where headlines are dominated by economic anxiety and partisan conflict. Experts also note that this open-to-talk statement came shortly after private signals were sent through back channels, via envoys, business liaisons, and diplomatic intermediaries. That suggests China had already anticipated a U.S. overture and set the stage to respond with composure. Ultimately, China's message is clear: we're not backing down, but we're not escalating. We're waiting, your move, America. To truly understand what's at stake, we need to shift focus from short-term policy decisions to long-term strategic thinking. Both Washington and Beijing are not just reacting to each other, they are positioning themselves for the next decade of global dominance. And this trade war, with all its headline-grabbing tariffs and policy statements, is just one theater of a much broader geopolitical contest. From the American perspective, the Trump administration sees trade as leverage. Not merely an economic tool, but a means to reshape global supply chains and reassert U.S. sovereignty in production, innovation, and critical infrastructure. Trump's economic advisors frequently cite the need to decouple from China, a term that once sounded extreme, but is now embedded in official documents, budget proposals, and even campaign rhetoric. This decoupling isn't just about cheap goods. It's about semiconductors, artificial intelligence, quantum computing, and military applications of emerging tech. It's about who controls the backbone of the 21st century economy. Washington knows that if the U.S. remains reliant on Chinese components, especially in sensitive sectors, it risks not only economic dependency, but strategic vulnerability. On the other side, China is playing the long game. The Belt and Road Initiative continues to deepen China's economic ties with Africa, Southeast Asia, and Eastern Europe. These aren't just trade deals, they're influence-building projects. Every rail line, port lease, and infrastructure loan extends China's presence in strategic regions, allowing it to bypass Western-controlled institutions and reshape global standards. Beijing also understands narrative. In 2025, China isn't trying to beat the U.S. in a frontal clash, it's working to outlast and outmaneuver. Where the U.S. imposes sanctions, China offers investment. Where the West warns of authoritarianism, Beijing presents itself as a model of stability and efficiency. This contrast plays well in parts of the world weary of Western lectures and longing for economic opportunity. Military posture also plays a subtle but crucial role. While there are no tanks involved in a trade war, there is power in deterrence. The U.S. continues to bolster its Indo-Pacific Command, expanding joint drills with Japan, Australia, and the Philippines. Meanwhile, China grows its navy and militarizes artificial islands in the South China Sea. These moves aren't directly related to tariffs, but they're reminders of each side's capacity to project force. Economically, both countries are trying to de-risk without triggering collapse. The U.S. is investing heavily in reshoring industries, offering subsidies for semiconductor plants, and tightening controls on outbound investment to China. In return, China is doubling down on self-reliance, pouring resources into indigenous tech development and reducing dependence on foreign software, chips, and platforms. This strategic mirroring creates a kind of economic Cold War. It's not about bombs, it's about control of resources, standards, narratives, and alliances. Each side is testing how far it can push before the other escalates. And that's what makes the May 4th development so interesting. It came just as analysts feared a spiral. Instead, China stepped back, slightly, and Washington hesitated. Think tanks on both sides of the Pacific are studying this pause intensely. Is it a sign that both sides have overplayed their hand? That inflation, consumer backlash, and investor anxiety are taking their toll? Or is it part of a larger pattern, where moments of tension are followed by calculated retreats, only to return stronger? One important factor is perception among allies. Europe, for instance, has become more assertive in charting its own path. The EU's Digital Markets Act and Carbon Border Adjustment Mechanism show that Brussels no longer wants to be just a bystander. If the US and China appear locked in dysfunction, Europe may position itself as the new center of regulatory gravity. India, too, is watching. As the world's most populous country, and a rising tech hub, it has a lot to gain, or lose, depending on how the US-China balance evolves. New Delhi has increased military spending, restricted Chinese tech companies, and welcomed US defense partnerships. But it remains cautious, seeking strategic autonomy rather than becoming anyone's pawn. In Latin America, Africa, and Southeast Asia, governments are taking notes. They see in this trade war not just risk, but leverage. In a multipolar world, being courted by both Washington and Beijing can bring dividends. Infrastructure, loans, trade deals, and attention, all are in play. In short, strategic positioning is the metagame of the trade war. Tariffs are just pawns. The real pieces are tech ecosystems, influence corridors, military reach, and institutional reform. Every move, from a factory subsidy in Ohio to a port built in Kenya, feeds into a larger contest about who writes the rules of the next global order. May 4th may one day be seen not as a breakthrough, but as a reset point. The moment when both sides blinked, regrouped, and prepared for the next round. While much has been said about China's strategic patience, less attention has been given to why the US finds itself needing to extend the olive branch first. Beneath the rhetoric of strength and tariffs lies a growing set of internal pressures forcing Washington to reconsider its stance. The first and most immediate factor is economic performance. In Q1 of 2025, the US economy shrank by 0.3%. Though modest, it was the first negative growth reported in 3 years, triggering alarms from Wall Street to Main Street. Key sectors such as manufacturing, tech, and retail have all reported slower hiring, weaker earnings, and reduced capital spending. Much of this contraction has been linked to the trade conflict with China. American businesses, particularly those dependent on imported goods or global supply chains, have faced rising costs. Retail giants like Walmart and Target warned of unavoidable price hikes for consumers, and smaller businesses are feeling the squeeze from disrupted logistics and unpredictable tariffs. The consumer is also under strain. Inflation, which had eased in late 2024, began creeping up again as import costs rose. Everyday goods, from electronics to household supplies, became more expensive. For working-class Americans, the trade war isn't just a headline, it's showing up on receipts. Politically, the Trump administration is facing mounting pressure from within its own base. In key swing states like Michigan, Wisconsin, and Pennsylvania, which helped secure Trump's 2024 victory, voters are watching jobs and wages stall. Farmers, who had previously been promised bailout packages, are demanding long-term solutions as Chinese tariffs slam U.S. agricultural exports. Unions and business coalitions have also grown more vocal. The National Retail Federation, U.S. Chamber of Commerce, and semiconductor industry groups have all lobbied against prolonged trade aggression. Their argument is simple: economic nationalism might win votes, but it's losing market share and growth potential. The timing compounds the problem. With the 2026 midterms on the horizon, political calculus is shifting. While maintaining a tough-on-China image remains popular with certain segments, ongoing economic uncertainty could turn into a liability. The Trump administration needs a win, or at least a pause, to claim stability and effectiveness. Meanwhile, international confidence in U.S. leadership has started to wobble. Allies in Europe and Asia have expressed concern over unpredictability in U.S. policy. Financial markets are jittery. Foreign investors are asking whether America can sustain an economic Cold War while keeping domestic stability intact. The Federal Reserve, too, has weighed in, cautiously. While still prioritizing inflation control, the Fed has acknowledged external shocks from trade tensions as risk factors in its latest economic outlook. If growth slows further, interest rate cuts may become necessary, but those come with long-term debt consequences. Strategic industries have sounded alarms as well. Tech giants like Apple and Nvidia report rising costs and logistical hurdles. Auto manufacturers warn of a potential parts shortage. The very goal of building domestic resilience is being undermined by rushed and reactionary trade measures. All this builds up to one unavoidable conclusion: the U.S. is not negotiating from a position of overwhelming strength. Instead, it's managing damage while trying to reframe the conflict as purposeful, controlled, and ultimately winnable. Thus, when the Trump administration initiated informal outreach to Beijing in late April, through diplomatic and corporate back channels, it was not merely exploratory. It was urgent. The public statement from China on May 4th, indicating willingness to talk, may have seemed like an offer. In reality, it was a reply. The U.S.-China trade standoff is not just a bilateral affair, it has deep and far-reaching effects across the global economy. What began as a dispute over tariffs and trade imbalances has spiraled into a systemic disruption, shaking the foundations of global commerce. In financial markets, volatility has returned with a vengeance. The Dow Jones and Nasdaq indexes have seen erratic swings since early April, largely driven by investor fears of an extended trade conflict. In Europe and Asia, similar trends follow. Frankfurt, Tokyo, and London exchanges are mirroring the uncertainty. The MSCI Global Index has declined by 4% in just 3 weeks. Businesses worldwide are feeling the pain. Manufacturers in Germany and South Korea report delays in sourcing critical components. Indian pharmaceutical companies, reliant on precursors from China, are sounding alarms. In Brazil, soybean producers are experiencing price instability as trade flows realign. The global economy, tightly interlinked by decades of globalization, is showing signs of fracture. Consumers, too, are being hit. In the US, prices for electronics and household essentials are rising. In Africa and Latin America, where Chinese goods are staples, costs are climbing due to disrupted logistics and higher duties. Inflation is no longer a domestic issue, it's imported, redistributed, and shared globally. This uncertainty has driven governments to reconsider their economic dependencies. Countries like Vietnam and Mexico are seeing surges in manufacturing investments as companies seek to diversify supply chains. Meanwhile, the EU is accelerating its strategic autonomy agenda, reducing reliance on both US and Chinese inputs. The trade war has become a global reckoning. It forces businesses to re-strategize, governments to renegotiate, and citizens to recalculate their expectation. The U.S.-China trade standoff is not just a bilateral affair, it has deep and far-reaching effects across the global economy. What began as a dispute over tariffs and trade imbalances has spiraled into a systemic disruption, shaking the foundations of global commerce. In financial markets, volatility has returned with a vengeance. The Dow Jones and Nasdaq indexes have seen erratic swings since early April, largely driven by investor fears of an extended trade conflict. In Europe and Asia, similar trends follow. Frankfurt, Tokyo, and London exchanges are mirroring the uncertainty. The MSCI Global Index has declined by 4% in just 3 weeks. Businesses worldwide are feeling the pain. Manufacturers in Germany and South Korea report delays in sourcing critical components. Indian pharmaceutical companies, reliant on precursors from China, are sounding alarms. In Brazil, soybean producers are experiencing price instability as trade flows realign. The global economy, tightly interlinked by decades of globalization, is showing signs of fracture. Consumers, too, are being hit. In the US, prices for electronics and household essentials are rising. In Africa and Latin America, where Chinese goods are staples, costs are climbing due to disrupted logistics and higher duties. Inflation is no longer a domestic issue, it's imported, redistributed, and shared globally. This uncertainty has driven governments to reconsider their economic dependencies. Countries like Vietnam and Mexico are seeing surges in manufacturing investments as companies seek to diversify supply chains. Meanwhile, the EU is accelerating its strategic autonomy agenda, reducing reliance on both US and Chinese inputs. The trade war has become a global reckoning. It forces businesses to re-strategize, governments to renegotiate, and citizens to recalculate their expectation. As we look ahead, the future of U.S.-China relations remains uncertain. But from the data, the dialogue, and the diplomatic moves so far, 3 primary scenarios emerge. First is the path of successful negotiation. If both sides agree to de-escalate, we could see a phased rollback of tariffs, targeted agreements on tech and IP protections, and re-established diplomatic channels. Markets would likely respond with optimism, and global growth could rebound in late 2025. However, this scenario requires mutual compromise and political courage on both sides. The second path is continued escalation. If talks stall or new provocations emerge, both sides could ramp up tariffs further or extend the conflict into digital domains, targeting data flows, software, and AI. This outcome would deepen global economic pain, accelerate decoupling, and potentially spark regional security tensions, especially in the Indo-Pacific. The third and most likely scenario in the short term is strategic stalemate. Here, both nations keep tensions high while avoiding open confrontation, trading barbs but stopping short of major new escalations. This could preserve flexibility for future talks, but also prolong uncertainty for businesses and markets. No matter the outcome, one thing is clear: the May 4th turning point won't be the end of the story. It's just the start of a more complex, multipolar phase in global geopolitics. The U.S.-China trade tensions have moved beyond simple economics. They've become a symbol of a shifting world order where power, influence, and technology collide. What happens next will not only define the future of these two nations but also set the tone for a generation of global diplomacy and commerce. The decisions made in Washington and Beijing will ripple through boardrooms in Berlin, farms in Iowa, ports in Singapore, and households everywhere. Every tariff, every policy shift, every diplomatic gesture carries consequences that are local and global at once. May 4, 2025, won't be remembered for a treaty signed or a tariff repealed, but for something more subtle: a pause. A breath. A chance to rethink the trajectory we're on. It's a reminder that even in rivalry, there's room for strategy. Even in competition, there's space for dialogue. As we continue to track this story, we invite you to stay informed, stay critical, and stay engaged. Because whether you're a policymaker, a student, or a citizen concerned about where the world is heading, this is your future, too. If this analysis gave you a deeper perspective, don't forget to like, share, and subscribe. Help us keep bringing you global stories that matter, unpacked, explained, and connected to your world.